So you have $1 million in your 401k and may be feeling pretty good about yourself, but have you ever asked yourself if you can have too much money in your 401k? In short, the answer is yes. Here's why. When you make contributions to a 401k, you are doing so with pre-tax dollars. That means you're getting a deduction at your marginal tax rate today, and you're postponing the taxes on those dollars until some point down the road when you plan on taking them out to pay for your lifestyle in retirement. So the question becomes, will your tax rate when you retire be higher or lower than it is today? If your answer is lower, then there is no limit on how much you should have in your 401k. Have $1 million, have 10 million, and the math will always work out in your favor. However, if your tax rate is likely to be higher when you retire than it is today, then having $1 million in your 401k retirement is a mistake of gigantic proportions, unless you convert it to a Roth IRA in relatively short order. First of all, what reason do we have to believe that your tax rate may be higher in the future than it is today? After all, conventional wisdom says that in retirement you'll be living on less, spending less, and therefore be in a lower tax bracket. And while all that could potentially be true, there's another factor of which you need be aware. Most economists are now predicting that tax rates even 7 years from now have to rise dramatically, or we go broke as a country. This is primarily due to unfunded obligations for Social Security, Medicare, and Medicaid. Unfortunately, the federal government has promised way more than it can afford to deliver for these programs, so they're throwing everything on the national credit card. In fact, in Joe Biden's most recent budget proposal, it's projected that the national debt will grow from $31 trillion to $51 trillion in the next 10 years alone. However, some experts claim that the publicly stated national debt is actually much lower than what it is in reality. For example, Professor Larry Kotlikoff out of Boston University is the foremost expert in the world in what is called fiscal gap accounting. And what he does is he projects out over the next 75 years what the U.S. has promised to pay for Social Security, Medicare, and Medicaid, and then he projects out over that same time period what we can actually afford to deliver under today's tax rates. And he says, if there's a difference between those two numbers, then your country has a fiscal gap, and that's its true national debt. He says the true national debt in our country is not $31 trillion. It's much closer to $239 trillion. What does that mean? It means we would have to have $239 trillion sitting in a bank account today, earning Treasury rates, roughly 5%, to be able to deliver on everything that we promised that we can't afford to pay. So all of this evidence leads experts to believe that tax rates will have to rise dramatically in the immediate future. How high, you might ask? Well, former Comptroller General of the federal government, David Walker, predicted in his best-selling book, Come Back America, that taxes will have to rise to an effective 45% rate across the board for all Americans by 2030 to keep our country solvent. So knowing that there's a massive tax freight train bearing down on your 401k, does it make sense to have $1 million inside it? The answer, of course, is a resounding no. You've gone into a business partnership with the IRS, and every year they get to vote on what percentage of your profits they get to keep. Not a very good business partnership, if you ask me. How much of that money is really yours after all? Hard to say, unless you can accurately predict what tax rates will be in the year you take that money out. You don't really know how much money you have, and it's pretty hard to plan for retirement if you don't know how much money you have. The ideal amount to have in your 401k if you're married is much closer to $350,000. Why do I say this? Because by the time you're forced to take RMDs at age 73, you'll have a standard deduction to help offset those RMDs. The rule of thumb here is that you want a balance that's low enough that the taxes on those RMDs can be offset by your standard deduction, but also low enough that those RMDs don't cause Social Security taxation. And as it turns out, the ideal balance that allows you to obey both of those thresholds is about $350,000. And that turns your 401k or IRA into what I call the Holy Grail of financial planning. Why do I say this? Because you got a deduction when you contributed the money. You didn't pay tax as your money grew, and then you took the money out 100% tax-free. And this can only happen if you're very proactive and intentional about the amount of money you have in these types of investments. In summary, in a rising tax rate environment, you don't want to have unlimited amounts of money in tax-deferred investments like 401ks and IRAs. When you leave it up to the IRS to determine how much of your hard-earned retirement savings that you get to spend, then you really are rolling the dice on your retirement. If you want to learn more about how to wring the most out of your retirement savings, be sure to check out my tax-free toolkit. You can download it for free at taxfreetoolkit.com. If you're a financial professional and want to learn how to become a Certified Power Zero advisor, head over to powerzero.com and opt into my free 3-part video series. By the way, if you have any comments or questions, feel free to drop them into the comments section below. I respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is Dave McKnight. I look forward to seeing you on the next video.